Could this week's earnings from tech giants like Apple and Amazon, combined with critical economic data, signal a turning point for the S&P 500, Nasdaq, and Dow? As global trade tensions ease, investors are on edge, and your portfolio could feel the impact. Stay tuned to find out what's driving markets and how US investors can seize opportunities. Welcome to Investor Economy, your go-to channel for decoding geopolitics, markets, and investing. I'm David, and today we're diving into a pivotal moment for US stock markets. The S&P 500, Nasdaq, and Dow are showing mixed signals as investors brace for a flood of corporate earnings and economic data. But what's really moving the needle? A shift in global trade rhetoric, particularly around tariffs, is creating both risks and opportunities for investors worldwide. Let's unpack this and explore what it means for your investments. To understand what's happening, let's set the stage. Since early April 2025, global markets have been rocked by escalating trade tensions, particularly between the US and China. President Trump's aggressive tariff proposals, including a 104% levy on Chinese goods, sent shockwaves through Wall Street, with the S&P 500 losing $6.5 trillion in market value since its February peak. The Nasdaq even entered bear market territory, down over 20% from its December high. But last week, markets roared back, with the S&P 500 gaining 3.8%, the Nasdaq jumping 5.4%, and the Dow climbing 2.4%. Why? A dialing back of harsh tariff rhetoric and optimism about potential trade deals, including a US-EU agreement, sparked a rally. This shift ties into a broader trend. Global trade dynamics are reshaping economies. For example, recent data shows China's retaliatory 84% tariffs on US products have disrupted supply chains, pushing up costs for industries like tech and manufacturing. These developments are critical because trade policies directly impact corporate profits, stock valuations, and investor confidence, especially in the US, where markets are highly sensitive to global supply chains. Fast forward to today, April 28, 2025, and US markets are at a crossroads. On Monday, the S&P 500 edged up 0.1%, the Dow gained 0.5%, but the Nasdaq dipped 0.2%. Investors are laser-focused on two things: corporate earnings and macroeconomic data. This week, over 180 S&P 500 companies, including heavyweights like Microsoft, Meta, Apple, and Amazon, will report first-quarter results. These tech giants, part of the so-called Magnificent Seven, are critical because they drive nearly 30% of the S&P 500's market cap. Strong earnings could signal resilience despite tariff pressures, while weak results might reignite volatility. On the economic front, key reports are incoming. Tuesday brings the JOLTS job openings and consumer confidence data. Wednesday delivers US GDP and core PCE inflation figures, and Friday wraps up with the all-important payrolls report. These indicators will shape expectations for Federal Reserve policy, especially after Chair Jerome Powell signaled caution amid tariff-related economic challenges. Meanwhile, the 10-year Treasury yield climbed to 4.28%, reflecting investor bets on higher inflation, a trend tied to rising trade costs. The geopolitical angle is equally compelling. The US-China tariff spat has hit industries like semiconductors, with companies like Nvidia facing export restrictions to China. This has ripple effects across global tech supply chains, raising costs and squeezing margins. Conversely, sectors like US manufacturing and energy could benefit from reshoring and trade deal optimism. So, what does this mean for markets and your portfolio, especially if you're a US investor? Let's break it down. The easing of tariff rhetoric has boosted market sentiment, but volatility remains a risk. Tech stocks, which dominate the Nasdaq, are under pressure due to supply chain disruptions and China's retaliatory tariffs. For example, Apple and Amazon, reporting this week, could face margin compression if trade costs rise further. However, strong consumer demand and AI-driven growth might offset these headwinds, making their earnings a critical litmus test. For US investors, here are actionable insights. Bullish opportunities. Consider the Energy Select Sector, SPDR ETF XLE, which could benefit from higher oil prices amid trade-driven supply constraints. US manufacturers, like those in the Industrial Select Sector SPDR Fund XLI, may gain from reshoring trends as companies move production stateside. Bearish risks. Tech-heavy ETFs, like the Invesco QQQ Trust, QQQ, face risks from tariff-related cost increases and export curbs. Consumer discretionary stocks, sensitive to inflation, could also struggle if core PCE data signals persistent price pressures. Long-term trends. The US dollar's strength, with the dollar index at 99.30, supports investments in dollar-denominated assets. However, a potential slowdown in global trade could cap growth in emerging markets, favoring US-focused funds. Data backs this up. Deutsche Bank recently slashed its S&P 500 forecast to 6,150 from 7,000, citing tariff impacts on earnings, projecting 2025 S&P 500 EPS at $240 versus $282 previously. For US investors, this underscores the need to balance growth stocks with defensive sectors like energy and industrials. Looking ahead, the trajectory of US markets hinges on three factors: earnings outcomes, economic data, and trade policy developments. If tech giants deliver robust results, the Nasdaq could regain momentum, but disappointing earnings might trigger a sell-off. Similarly, a higher-than-expected core PCE inflation reading could push Treasury yields up, pressuring growth stocks. On the geopolitical front, watch for updates on US-EU and US-Ukraine trade deals, which could stabilize markets. For US investors, strategic moves include diversification. Allocate to defensive sectors like energy, XLE, and utilities to hedge against volatility. Hedging. Consider Treasury ETFs, like the iShares 7 to 10-year Treasury Bond ETF, IEF, to protect against rising yields. Long-term plays. Focus on US-centric funds, like the Vanguard S&P 500 ETF, VOO, to capitalize on domestic resilience. The big picture? Trade dynamics and economic data will dictate market direction, but selective investing can turn uncertainty into opportunity. That's it for today's deep dive into markets and geopolitics. If you found this valuable, hit that like button, subscribe to Investor Economy, and ring the bell for more insights on investing and the global economy. In the comments, tell us, which stock or sector are you eyeing this week? Next time, we'll explore how rising inflation could reshape your portfolio. Stay informed, stay invested, and I'll see you in the next video.